So last session we introduced the weighted average cost of capital function, and in that we're going to take the cost of debt times the weight of debt, adjust that for taxes, the cost of equity times the weight of equity. So let's start with the cost of capital for bonds. So it's going to be related to their bond ratings. You reference the bond ratings on your paper 1 and in exam 1, so I won't go through those again, but AAA, very highly rated, single B, triple C, very lowly rated. So lower rated bonds are going to have a higher risk premium. We call that a spread. So the risk premium for bonds in the bond market is called a spread. The higher the spread, the higher the discount rate. So you should get a lower value for that bond because it's riskier. You should have to pay. You should be able to get a lower price for that bond because it's riskier. Now, important on spreads, make sure everybody's really clear on this. Spreads are expressed in what we call basis points. So a basis point is 0.0001 or 0.01%. So 50 basis points is 0.5%. 100 basis points is 1%. So if you're not sure, just take the basis points. If something's 50 basis points, take 50 and divide by 10,000, and that will convert it into a decimal, and that's what you're going to add to the risk-free rate. So the cost of debt is the weighted average current market value yield, market yield on that firm's debt. I'm going to show you real quickly how we calculate it for our class. It's very straightforward. Most firms will know this. When I worked at UTSA, I could go and get this number from the department that borrows money for UTSA. Any firm will have a department. It will be a very small department. You don't need 50 people to do this. It usually is only 1 or 2 people. But they will know the firm's cost of debt. It may be multiple pieces of debt. They may have some 1-year bonds and some 3-year bonds, some senior bonds, some junior bonds, bonds that have collateral, bonds that don't have collateral. They'll know the weight of all of those costs of debt, and they will be able to give you a cost of debt. Now, if you're a bank or an insurance company, I remember at UTSA, our cost of debt included things like our certificates of deposit. We may have certificates of deposit that our bank sells, and those certificates of deposit, they have a rate. So we might pay 2% to our customers on their certificates of deposits, or the life insurance company might have some annuities that they're paying 3%. We would put that as part of our cost of debt. So it can get quite complex. So once you have that yield, and I'll show you how to get that yield, you take that cost of debt and multiply it by 1 minus the marginal tax rate, not the effective tax rate, the marginal tax rate. That's the tax you would pay on the next dollar of earnings that you would make. So cost of debt equal the risk-free rate plus the risk premium, or the risk-free rate plus the spread. There's the bond ratings we talked about before. Let me show you. I'm not going to do the entire weighted average cost of capital Excel application. I just want to show you the first problem you have. It's application 6, and the first problem you have, it's for Kroger's. And what I tell you is the average maturity of their bonds is 7 years. So 7's what's important, because that's going to do 2 things. It's going to tell you which risk-free rate to use, which is a treasury yield, and it's going to tell you what spread to use, 7-year spread. And it's rated AA, so that's really important. It's 7 years bond, and it's AA. That tells us everything we need to know. So let's go down and say, well, what risk-free rate will we use? Well, the risk-free rate should be a treasury yield of the same length as the bond. If their bonds are on average 7-year bonds, then you want to use a 7-year treasury. So you just link that up to there. So our risk-free rate is 3.6%. And then what is the spread? Well, the bonds are rated AA. So it's a 7-year bond, and it's rated AA, not AA plus, not AA minus, but AA. So you go back and you see the credit rating, AA. You find the intersection of those two, and it's 80. So what is the cost of debt for this firm? The cost of debt for this firm is going to equal the risk-free rate plus the spread. Here we say the risk-free rate is the treasury because it's a 7-year bond. We use a 7-year treasury, and that's 0.036. Convert your percents into decimals. Just divide 3.6 by 100 and you get 0.036 plus our spread, where our spread is 80. 80 divided by 10,000 equals 0.008. So we're going to take 0.036 plus 0.008. So make sure on the basis points you know how to do that division. So plus 80 divided by 10,000 gives you 0.008. You take 0.036 plus 0.008 and you get 0.044 or 4.4%. All right, so that's good practice. If you know basis points, boy, it's very important, especially if you're a finance major, because you will discover once you get out into business, bond investors don't talk interest rates, they talk spreads. I remember one of my first job in finance, the corporate treasurer came out of his office, was so excited. USAA had borrowed money for the first time in its history, and they got a really good rate. And the corporate treasurer came out and said, we got it at 16 over. We got it at 16 over, whatever he said. I can't remember what number he used. I was the only one in the department, and he was so excited. I had no idea what he was talking about. He got what at 16 over what? But what he was saying is USAA borrowed for the first time in its history at 16 basis points over the risk-free rate. It's a really good rate. It's probably lower than that. I had no idea what he was talking about. He had one look at me and it's like, why do we hire this guy? He doesn't know anything about finance. I just was not used to hearing people talk in basis points, but in his world, that's just the way people talked in basis points. All right, so that's how you'd work the KD. You can see on the other problems, it's very, very, very similar. On the exam, it'd be very, very similar. You just have to know the line up the year with the rating. That gives you the basis points. Line up the year with the treasury. That gives you the risk-free rate. One thing, don't get confused on this. When we get the stocks, this does not apply to stocks. On stocks, we always use the 10-year treasury for all stocks. So just be real careful. For bonds, you got to get the years of maturity for bonds and the rating to get all your numbers there. For stocks, the only treasury you need for stocks is the 10-year. It doesn't matter what the bond's maturity was. All right. So I'm saying that now. I'll say it definitely again. Some students get confused on that. All right. So that's bonds. You can see bonds are very straightforward. There's the definitions of the investment grade and below investment grade bonds from S&P and Moody's. All right, so let's get the stock cost of equity for stocks. This is much more difficult, much more theoretical, much more subjective. So the way we're going to do this, we're going to again use a risk-free rate plus a risk premium, but we're going to use a famous theory in finance. If you want more reading on this, if you type in capital asset pricing model, a few sites will come up. One will be Investopedia. You might start with that. If my definition is not clear enough for you, you can read others' definitions. But Investopedia and Wikipedia are two places to go to get a more detailed discussion of this. Also, any finance textbook will have a whole chapter on the capital asset pricing model. So there's plenty of places you can go. The formula looks the same. What we're going to do with the capital asset pricing model is we're going to take this risk premium and we're going to split it between two pieces. A risk premium for stocks in general, we call that the market risk premium. The market risk premium. And then an adjustment for risk for the individual stocks. And we're going to use, you've probably heard this term before, we're going to use beta to do that. We'll have to talk about what beta means. But the capital asset pricing model, this is it. This is the formula. It's a very simple formula. Every finance major knows this. Probably every business major knows this formula. The required return for stocks is the risk-free rate. We're going to use the 10-year treasury for that. Plus beta. We'll have to talk a lot about beta. Times the market risk premium. We'll talk about the market risk premium here in a little bit. So you have three numbers to obtain. The advantage you have for our problems is I just told you use the 10-year Treasury yield for the risk-free rate, so you just pick that up, and I give you the market risk premium. So that's a given. So beta really is the only difficult thing you have to do. And I've given you some Excel applications to give you some practice with that. All right, so for CAPM, we're looking for the appropriate discount rate, the required rate of return to use for valuing a stock. It's what you would use if you were an investor trying to figure out which stocks you want to buy. It's what you would use if you work for Valero and trying to figure out the cost of capital for Valero. It's the exact same process for both groups. All right, so the risk-free rate, very, very simple. We are going to use the 10-year Treasury yield. Now, the 10-year Treasury yield is so low right now, especially right now. There are some people who argue to normalize it. I used to be in that camp. I've kind of somewhat changed my opinion recently. I use something called the forward curve now. We're not going to talk about that, but if you remember when we were talking about inflation, I talked about bootstrapping the yield curve, and that's the forward curve. So I'm more in use the forward curve. Right now, it doesn't matter what you do because the 10-year Treasury is so low, and it's been low for so long. It's simply an issue no one really has a good answer for. For the Excel applications, if you'll notice, I have a 10-year Treasury yield for all of the examples that's much higher than today. You can look at the second one, the second problem. I use 2.9. So you only have two problems. I'm going to work the first one for you. So 2.9 is still high versus today. So you don't have to worry about that. You just use the 10-year Treasury and you're done. There is a lot of debate about which Treasury to use, but in practice, the most common approach is to use a 10-year Treasury. There is an article, a blog, it's a little bit old, but it still works today, written by Dr. Damodaran, asking about what do we do with these low interest rates. My guess is he probably has changed his opinion with the 10-year Treasury actually falling below 1% and now just barely above 1%. He may have changed his opinion on that. But you can read that if you want more. It's a very easy read. You don't need it for this class, but if you're a finance major, I'd recommend you read. Dr. Damodaran has some really good articles on the risk-free rate and on the market risk premium. There's an article, I think I put it on Blackboard. If not, I'll put it out there on the market risk premium. There's some really good reading. What you have to be careful of is some of the articles are extremely technical and hard to read, but the articles I would provide to you on either one of these topics are very easy reads and get into the details and very fascinating topics. All right, so that's it for the risk-free rate. Very, very simple. So let's talk about the market risk premium. The market risk premium is how much someone investing in the stock market in general, how much more do they need to make over the risk-free rate to induce them to buy stocks in general. That number can range anywhere from 2 or 3% to as high as 8%. Some people say it's negative. The people who say the market risk premium is negative is not really saying you should use a negative market risk premium in the cost of capital. What they're saying is they think the stock market's terribly overpriced. So that's a very different analysis. So the most common approach to getting the market risk premium is what's known as the implied approach. I don't think I put it in the notes here, which is somewhat unusual. I'm sure I've got it somewhere in here, but it's the implied approach. So let's talk about the applied approach. This will probably be the last thing we'll do in this session. So what the implied approach says is there is a required return on stocks, what we need to compensate us for risk, and there is an expected return on stocks. The required return on stocks is very theoretical. There's no place to go to calculate that number. We don't know what it is. There's no formula for it. But we can calculate the expected return on stocks. The expected return on stocks is the current dividend yield on stocks, which right now is about 2%, plus expected earnings growth on stocks. We can get the current dividend yield. We just look it up. And the expected earnings growth on stocks, that's not too bad because expected earnings growth should be about expected economic growth. So if our economy is going to grow 5, 6, 7%, then we can expect corporate earnings to grow 5, 6, 7%. I'll get into this more next session, but let me explain how we're going to link this. So the question is, does the required return on stocks, does that equal the expected return on stocks? This might be in the notes later, but I'll put it here because it fits here very, very well. And the answer to that is theoretically always. Why is that? Well, if stock investors require 10%, but they expect to make 6%, what is going to happen? Well, if they need 10 and they think stocks are only going to give them 6, they're going to sell stocks. Everyone's going to sell. Stock prices fall. And expected returns will rise. If you can buy stocks at 30% lower than you did a few days ago, then your expected return will be higher. So if required return is high and expected return is low, stock market will let stock prices fall because everybody's selling, no one's buying. Stock prices will fall until they fall low enough such that the expected return on stocks jumps up to 10%. What if the stocks are expected to make 10%, but stockholders only need 7%? Well, what's going to happen there? Well, everyone is going to buy. Stock prices will rise. Prices go up. When stock prices rise, all else equal, expected returns are going to fall. And eventually the market will be back in balance. What we call this is market efficiency. Markets are efficient. They're not mispriced. Stockholders price stocks exactly what they expect and what they require. And so since the required return on stocks equals the expected return on stocks, and given that we can calculate the expected return on stocks, but we need the required return on stocks, what the implied approach says, use the expected return on stocks as a proxy for the required return on stocks. So I'll leave it there. Very, very important concept. And what we'll do is we'll need to walk through this. This might take us a little bit next session because I want to show you some graphs and some articles that you can use that can help you with this concept. Extremely important concept. This for you finance majors. I know cybersecurity, marketing, you may not care as much about this, but finance majors, the market risk premium, also known as I forget the other term. I'll give you the other term. There's two terms for market risk premium. Oh, equity risk premium. Excuse me. The market risk premium, equity risk premium, the exact same thing. You will frequently see this referred to as the most important number in finance. So it's an important number to know. So we'll start there. Hopefully you're getting some sense of where we're going with the return on stocks. It is a little more complex.